For tuning into Talking Point. I'm your host, Neeraj Shah. And the fact that the markets have done what they've done in the recent past, as also there is the union budget upcoming, makes it an opportune time to get in one of the leading, if not the leading strategy voice in the country, Amish Shah. He's head of India Equity Research at BoFA Securities and manages strategy there, and joins us right now to talk about his thoughts on the current equity investing landscape, if you will, and what do they as a house expect out of the budget for the economy and from a markets perspective. Amish, great having you. Thanks for joining in.
Good morning. Thanks, Neeraj. It's always a pleasure to be on your show.
Thank you so much. So, Amish, before we dwell into the budget, it's pertinent to talk about the equity markets and the kind of maybe turmoil. You can use the term turmoil as well. What's happening? Some of your clients, because FIs will be the leading sellers, some of your clients might have some very interesting takes as well. What is it that you are advising them? Why is it that we're seeing such a selling? And does this show any near-term signs of stopping or ebbing, if you will?
So, Neeraj, look, this entire calendar year is full of events, and a lot of these events are actually negative. We all know Fed is one of the big risks out there. Fed rate hikes, I mean. There is, if you look at our house view, we are also talking about crude going to $120 a barrel by June this year. Obviously, we expect that in the second half, crude will ease off as well. And for the whole year, our average is 85, which is where we are broadly. But, in the first 6 months, crude is expected to go up a lot, and which is going to be negative news for the markets too. And then obviously there are local elections. Right now markets are budgeting in for incumbent, BJP to come back. But if that doesn't happen, that puts a pause to the reforms momentum that we have in India right now. So these are clearly all near-term large risks out there. And on the back of that, we do expect these intermittent corrections to happen throughout the year. But despite that, I do think that the markets for this calendar will end higher versus where we are today. Our Nifty year-end target is around 19,100. And there are three reasons that make us bullish, particularly for this year. So first, if you look India in a relative context, I'm sure you've heard this argument before too, but it actually does make sense. Let me just give you an example as a comparison with the other large EM, which is China. So if you look at China's GDP growth last calendar, it was 8%. This year, we are expecting it to half, to 4%. Last year's China's earnings growth was about 20%. This year, we are in the camp of it coming out to be 0 to 5%. So that's clearly a big deceleration, if I would use that word. In comparison to that, in India, 9.5% real GDP growth. We are expecting it to be, relatively stable at about 8.3. Next, if you look at earnings growth, last year was about 34% growth. On the back of that strong growth or a strong base, we are still talking about a 20% earnings growth. So clearly, whether you look at India in terms of GDP growth, earnings, return ratios, India really stacks up pretty well. When you look at the, you spoke about the FII flows, but if you look at the positioning of FIIs within the emerging markets, China is about 37% of their weight. India is about 17% of their weight. And in fact, these weights have only gone up despite the FII apparently looking like a sell. So if you look at from January last year, India's weight has actually gone up from 14% to 17%. So I do continue to believe that if India continues to outperform the region in terms of growth, which I think it will, flows that will get pulled out of China, even a small share of that getting diverted to India is going to be a positive news. And that's just one of the reasons. If you look at India on an absolute basis, we do think that after a pause of over a decade where corporate earnings growth was languishing, if you look at the period of 2012 to 2019, India's corporate earnings has grown at only 4% on an average, which is much weaker than the GDP growth. And there are many issues, sector by sector, if you look at it on a bottom-up basis. But now we think that India is heading into a phase where on a structural basis, India's corporate earnings growth can outpace the nominal GDP growth. And that as I'm saying, is a trend reversal after a decade. And if that trend comes up, investors are definitely going to be excited. And then lastly, I would say that this is also the time where we feel that India will see a confluence of three large cycles coming together, which is the Capex cycle. And I've discussed this with you on your show earlier too. We are very bullish on Capex. We are very bullish on real estate cycle, and we are very bullish on the credit growth cycle. And all of these three things coming together, historically, you could check that whenever they all come together, it leads to very robust economic growth, and earnings growth as well on the back of that. So on an absolute basis, India looks good. On a relative basis, India looks good. Yes, there are plenty of these near-term negative events that will create these kind of 2-3% market intermittent corrections, but I guess we'll have to live with it, along the way.
Yeah. Okay. Just I know you look at the slightly longer term, but I'm just trying to understand, Amish, in the very near term, because of the fact that February has at the start the budget and then the UP elections. I mean, there are others, but UP predominantly. Would you say that tactically it might be prudent to stay lightweight / underweight on the markets? Also, just a follow up to that, the last time that we spoke, as I remembered, your equity targets for the Nifty were a lot lower than the current levels. While your year-end targets may be higher, in the current phase, are your targets slightly lower than where we are right now?
Sure. So Neeraj, let me take that second part of the question. So you're right. In fact, last year our target was close to 15,000 for Nifty. Just compound to the fact that Nifty earnings are likely to grow at 20 to 24%. Right. So if you just multiply, I'm just trying to do a simple arithmetic here that if you just multiply that number, you will probably reach more closer to where we are today. So last year we think that markets had a little bit of an overshoot. And towards the end of the year, we were relatively bearish versus where the markets were. This year, on the back of the compounding or the roll forward of earnings growth coming together and the markets having corrected a little bit, it provides us an opportunity to be positive, in fact, this year. Right. And last year, there was also, the factor of India not looking that relatively great versus the other emerging markets. This year, India is a complete standout. So those two factors, do make, to some extent, a change in the view that we have taken this year. Coming to your first part of the question, is there a risk in the near term? I certainly believe there is. Because we all know that Fed earlier was talking about finishing it tapering by March end, and then starting the rate hikes thereafter. If you just go back to late December, early January, the expectation was that maybe Fed will start hiking by June. Now we are bringing it all forward. We are talking about Fed finishing its tapering by February, perhaps starting to start hiking by March, maybe even earlier. Right. So in the context of the risk factor brought forward, I think that the correction that we were expecting in throughout the year, or a small correction later in the part of the year, is all getting front-ended, and it is also coming together with the election point that you mentioned, that a lot of these states will go in for election in February, and the results are out on the 10th of March. So in the first quarter, all of these events seems to be a little bunched up, and yes, markets may be nervous on the back of that.
Got it. So this is fair value. It could well undershoot because of event-led stuff. But if it does undershoot and the markets were to correct significantly from here, you would see that as a buying opportunity based on what your assessment is for the year. Am I getting it correct?
Absolutely, Neeraj. Absolutely. Maybe just to substantiate one more point to that, while I spoke about corporate earnings growth doing better, look at the context of a lot of structural factors that were already playing out in India. But again, they are all coming together. So you would agree that India is rapidly getting more formalized, which means that this is the consolidation theme that was always going on, but after COVID is accelerated. So that means that while your economic growth may be X, your listed company universe, which is represented by organized companies, will grow at a multiple of that X because of the formalization theme. You also have India becoming more financialized, digitized, decarbonized. India is trying to put in a lot of its weight, trying to establish itself as a large, credible alternative to China in terms of supply chains. And it just comes at a time when I think a combination of all of these trends that were already playing out if they come together, and which we think are coming together, can lead to a super cycle in terms of earnings growth for corporates, as I was trying to argue.
Got it. Amish, just a couple of other thoughts. You mentioned the other big risk factor, which is crude, and the stoking of the geopolitical tensions might well have a part to play out there. It works for Russia. It doesn't impact the US as much because of the neutrality status that it now seemingly seems to have. So if that were to play out and continue to inch higher, would that continue to be a bugbear? Or do you think at some point of time, valuations might look so attractive that the markets will not mind the $120 crude to a barrel?
Sure. So Neeraj, again, $120 a barrel in the near term is a risk, and markets should react to that, in fact.
Okay.
But again, as far as that high crude prices doesn't become a base case for longer, and if it is going to be a transitory factor, then most investors will want to look beyond it and say that, okay, maybe for few sectors, few stocks, this is a real headwind. Maybe they will find it difficult to pass on that extra commodity price pressure. So sure, some sectors or stocks will have an impact, but then if it is going to be transitory, then markets will look forward and try to and I think that the markets will have a pullback on the back of that.
Got it. Amish, just a couple of focal points on the other event as well, which is the budget. And I read your note with interest. You have baked in some of the potential positives that the market may like, which is continuing on the, how do I say, at least the show of the glide path, even if near term there could be some spending, etc., that might be elevated. Can you take us through what is your key synopsis that you expect to come out from the FM's budget this time around come Feb 1?
So Neeraj, let me set the context for your viewers. If you look at the last year's budget, it was completely lopsided in the favor of Capex, right? And just to remind or put a number, we spoke about a 30% YOY growth in allocations towards Capex last budget, right? And it was very light on demand stimulus. Obviously, in reality, during FY22, government actually did increase subsidies and did give a demand stimulus eventually. But the fact is that the budget in FY22 was more Capex focused. Now there are when we are standing now, the consumption growth is visibly slowing, and especially from the rural economy, there is slowdown in terms of growth, and there is therefore a rising clamor that the government needs to support this growth and come up with some demand stimulus. This is also coming at a time when the government last year or in the last couple of years worked with a very high fiscal deficit number, given the pandemic pressures. But now we have to start on the glide path of fiscal consolidation. We can't have these kind of high fiscal deficits forever. In fact, you would recollect that the government has already set a target for FY26 in terms of saying that fiscal deficit of 6.8 for this fiscal will come down to 4.5 by F26. So you need to walk towards that particular path, right? So I guess what I'm trying to put in terms of context is that it's going to be a difficult task of balancing a reduction of fiscal deficit plus the need to do demand stimulus and continuing with Capex, stimulus. But we do think that a combination of all of these three is possible to do. We are currently arguing for a moderate demand stimulus of about $20 billion, which is broken up into $11 billion coming through some sort of tax breaks and around $9 billion of extra subsidies over and above what the government normally provides. So part subsidies, part tax breaks is where we think will be the demand stimulus. And $20 billion, just to put into context, is about 0.6% of GDP. So it's not very big, but there is at least some stimulus out there. In terms of Capex, we think that the government will target 20% growth, but 15 out of that will be funded through the budget. The residual 5 can be through infrastructure bonds through the new entity, which is NAPFID, which the government has incorporated now. And a fiscal deficit, we think government will come down meaningfully. We are talking about 100 basis point of contraction for 6.8% deficit to come down to 5.8 in FY23. So it's going to be a well-balanced budget in that sense. And over and above that, given the windfall tax receipts that the government has received this year, we think there is a scope for government to pay all the arrears, and pending payments that were out there. And if they do that, then markets will look at as continuing transparency of the budget, which is in a way a small reform. And the last point I would also argue, which is a little bit of a wishful thinking on our side, but what if the government combines the demand stimulus of tax breaks rather than just tinkering the tax rates, through a whole hog tax reforms? And this is coming back to the second option that the government had given a couple of years back, that you do away with all your deductions and work with a lower tax rate. One of the math that we've done that suggests that if you take away the deductions and if you cut, for the population that earns up to 50 lakh rupees per annum, if you cut their tax rates by 25 to 50%, which is like a very large cut in tax rate that I'm talking about, the impact on budget is only going to be 0.3% of GDP, right? So let me put it in terms of rates, that 30% tax rate goes to 20, for people earning up to 50 lakh rupees. And for the most popular category of tax bracket, which is 500,000 to 1 million, if you cut their tax rates to, let's say, 10% versus 20, which is like a 50% reduction in tax rate, all of this put together is only 0.3% or 832 billion rupees of impact. So it's possible to do from a number perspective. And I would argue that, that is a bigger reform in a way, because it reduces tax compliance on one hand, and on the back of lower taxes, it includes more people to start paying taxes and expands the tax net.
Interesting. What are the risks to this? Because the fact that nobody would debate that the GST revenues, if the economy has to grow the way everybody's penciling in, would probably only inch up higher. But surely you can't pencil in all forms of revenues that the government is getting with a straight line for the next 24 months. There has to be somewhere where there is a law of averages which will take place, right, Amish?
Absolutely, Neeraj. So in fact, one of the large reasons why government has got this windfall revenues is also because of the spillover effect. Because during COVID times in F21, the government pushed the tax filing deadlines, and therefore a part of the tax that was supposed to come in F21 is actually coming in 22, right? So absolutely right. In fact, in our numbers for FY23, we are taking a 5% decline in the total revenue receipts of the government. So clearly we are not extrapolating the growth. We are in fact talking about a decline in terms of receipts on a high base of FY22. But the thing out there, Neeraj, is that revenue expenditure as well has a scope of declining materially. And let me try to give you some details in here. You recollect that normal basis is about rupees as food city, but that number last year in FY22 was double that number. It was about 3.1 trillion rupees, and this is on the back of the government providing the free food program for the entire 12 months of FY22. As we now get out of the COVID phase, while we are conservatively still building in another 5-6 months in FY23 of free food subsidies continuing, in reality, I think that's a conservative number. In reality, that number may not be required. Even with that conservative number, if you believe that the government provides free food for 5 months in FY23, for the remaining 7 months, that expenditure is not there, right? So that brings down your food subsidy bill. Same goes for fertilizers. Since January last year, fertilizer prices have gone up by 2.5 to 3-fold. And on the back of that, the government last year increased fertilizer subsidy by about 0.6 trillion rupees, right? Right now, we are assuming that high fertilizer prices sustain, and therefore the fertilizer subsidy bill will be higher. But chances are that, like every commodity, fertilizer prices may come down, and there will be a saving, in fact, on the fertilizer subsidy bill that we put together. All of this put together, despite the conservative estimates that we've taken, there is a possibility for subsidies to come down by 20%. Right? So on one hand, your revenues are coming down on the back of high base, but then your expenditure is also coming down on some of the subsidies which are not required to be in place. And then from a risk factor perspective, I would argue about disinvestments. So
Yeah.
you would recollect that last year when the government presented the budget, there was very little hope that the government will actually be able to meet 1.75 trillion rupees of disinvestment target that they had. So far in this year, the government has been able to do only 5%. And they're actually trying very hard to bring the LIC IPO by the end of March, to get the revenues within this fiscal. But we have rolled it forward in F23. So we are looking at versus the government target of 1.75 trillion of disinvestment revenue. This fiscal talking about only 15,000 crores or 150 billion rupees of disinvestment revenue. That is like only 7-8% of what the government is expecting. But what that helps from a FY23 perspective is that revenue potential in F23 becomes even bigger, right? And a lot of groundwork, so if let's say if the government is saying confidently that they will be able to do LIC IPO by March 2022, it's very likely that they will be able to finish that by March 2023 because you get an extra 12 months to work on it. So I think disinvestment revenue numbers, at least when the government announces the budget, can be reasonably high. We think that it can be as high as 2.5 trillion rupees in FY23. But that also presents one of the biggest risks out there, Neeraj.
Got it. The other thing, Amish, you guys would have maybe thought through this, spoken about this. As always, pre-budget, the rumors of tinkering with capital gains rates comes about. You would have done some work, done some channel checks as well. How likely and how big a dampener or could it be, or would it be taken in stride?
So Neeraj, as a matter of fact, we are not building in any surprise, positive or negative, on the back of capital gains tinkering this time around. We think it's more going to be stable regime out there.
Okay. So, Amish, in light of the fact that this time around the government may be doing a path of, or at least embarking upon the path of the glide path of fiscal consolidation based on the targets, etc., and receipts being high because of both GST as well as maybe disinvestment for FY23, does it strengthen the case for the Capex, government-backed Capex, and eventually even private-backed Capex to come to the notice in a prominent fashion in FY23? Thus far, we've not seen private Capex pick up as much, but for stray incidents, although it's now starting to show some light. Do you reckon FY23 could be the year wherein, aided by the government and maybe private Capex as well, we'll actually see the proof of the pudding?
So, Neeraj, I think it will be one more year of a wait before private Capex really picks up in a big way. And I'll give you the rationale for that. So, first of all, let me try to clarify this, that, a lot of people, when they talk about private Capex, somehow start talking about utilization levels and why utilization will drive private Capex. But that's an argument that I've never really got, because if you really wonder what utilizations are you talking about, it is mostly about steel and cement, by and large factory utilizations. But let me clarify here that factory Capex or industrial Capex is only 2% of the total Capex in India. And it's also a very small part of private Capex. It used to be a pretty big part at some point in time. And maybe that's why it has got fixated in people's mind on looking at utilization, making a call on private Capex. But it's a very irrelevant way or a very small way of looking at the big picture. The large part of the private Capex is actually spent on infrastructure projects. So can private balance sheet be invested to put in, let's say, more renewable projects or transmission lines or airports and so on and so forth, right? That is a big part of the private capex. Now, historically, when we analyzed 20, 30 years of cycles, what we realized is that there is a very strong pattern that whenever the government opens a monopoly, okay, that leads to a massive scale up in private capex. Let me give you an example, right? You would recollect that up until 1998, so call it about 5-6 decades of creating highways, national highways in India. India had created only 40,000 kilometers of highway network, up to 1998. 98 is when we opened up the monopoly. In 2 decades thereafter that we are in right now, India's national highway capacity has gone up by 3.5x, right? And this is despite the fact that there was a 9 years of a down cycle in between, right? And the same example that I'm giving you for national highways is actually true for power transmission, power generation, renewable projects, airports. Wherever the government has opened a monopoly, there has been a J curve in terms of capacity addition that comes in that space on the back of private and foreign capital coming in. The only catch here is that there is a lag of 3 to 4 years from the time the government opens the monopoly till the time the private capital actually starts flowing in. And there is a very obvious reason for that, that when the government opens a monopoly, given the fact that private sector has never been in that space, so a private guy will first want to do due diligence on whether this business makes sense. Once they do that due diligence, they will want to incorporate a company, hire people, get their funding tie-ups, raise equity capital, debt capital. All of that takes away 3-4 years, right? But once that setup is in place, then all that they are eventually going to do is to bid for projects, win it, and execute it, right? So the short point here is that from the time government opening capex, it takes 3 to 4 years before it leads to a big ramp up in private capex actually happening. Now, we are right now seeing a trend over the last couple of years that the government is opening a lot of monopolies, right? If you look at it, gas distribution opened up, airports government is privatizing, defense from a practical perspective has been opened up now. Railway passenger movement privatized, government is open for private participation. Coal mining, there is no longer a monopoly of Coal India. And if power distribution law goes through, even power distribution sectors, monopoly of SEBs will be opened up. So there are plenty of sectors where the government is breaking monopolies, and this is a trend that is already playing out over the last couple of years. So using that thumb rule of 3-4 year lag, I do think that from F24 onwards, there will certainly be a very big scale up in private capex. In FY23, you will start seeing some signs of it or accelerating signs of it, but I don't think that the trend would have caught up completely yet.
Okay, Amish, one final question then. So what's the equity strategy? If we are indeed to move towards 19,100 or thereabouts, and with the assumption that the budget doesn't really do any damage, even if it doesn't do any material gains, so everybody be hoping that it does something meaningful as well. How do you play the Indian equities for the current year?
So Neeraj, for this year, our preference is definitely for investment-oriented stocks as compared to consumption. Investments, financials and industrial sector, we are very overweight. And while we are underweight on both the consumer sectors, which is staples and discretionary, we are also positive on anything to do with domestic cyclical revival. So that brings us to being overweight on financials and autos again. The only global sector that we are really positive right now is IT, because the visibility of growth in that space and the potential for price hikes now coming through to take away the problem of margin pressures that we've seen on the back of wage hikes so far, we think is quite likely. So barring IT, most of the domestic cyclicals like financials, industrials, autos, even utilities on the back of a potential of the new Electricity Act going through in the parliament, these are the sectors where we are overweight. In terms of the sectors where we are not excited or where we are underweight, so that includes consumer staples, discretionary, healthcare, the whole of material space, which is steel and cement, and energy sector. So these sectors we are underweight at this point in time.
Sorry, just one final cross question. If indeed the thesis is that even if the average is 85, which is not low, and if the highs could be 120 to a barrel to crude, why would you be underweight upstream?
Neeraj, as you would agree that there is always a lag between the actual crude prices and that flowing into the earnings of these companies, for a variety of reasons. They are regulated. There is a time lag in terms of the earnings flowing through. So we don't really think that the full benefit of that high crude prices is actually going to reflect in the earnings growth of energy companies, and that doesn't get us excited. Therefore,
got it. Fair call. Amish, great having you. Thank you so much for spending the time today and talking to us about the budget and about the current market environment. It's good to hear a voice which can calm some or soothe some frayed nerves, which might have got an impact in the last few days. So much appreciated.
My pleasure. Thank you.
Pleasure was ours. Viewers, thanks for tuning in.